Hi everybody, this is Phil Haloka from Complete Captive Management Services. Today we launch our next three-part series on the captive audit. Today's conversation is, why do you even have to worry about a captive audit? Well, let's talk about it. So, what is the audit and what is it not? Well, the easy question is, what is it not? It's not an expression of a right or wrong answer. The auditor's duty is to provide a work product that is fairly and accurately reflecting the information it is provided from the holder of the financial information. And usually that's the captive manager. So the captive manager at the time of the audit is going to remit the various data points, unaudited financials and workflows to the auditor, and that auditor will then do its duty. Now, if a business were given the option to do an audit or not, they would likely say, nah, my financials are already in GAAP. I don't need to have a third party review them because I know that they're right. Well, that becomes problematic. The reason a business thinks that is because the captive audit is a pricey transaction, okay? So unless it's required, it's unlikely that the captive would be willing to do an audit just to do it. Therefore, it's required by the domicile. You have to do it. So the captive on a yearly basis has to engage an auditor to complete the audit, usually due by the end of June of each year for the reporting of the prior year. Now, there are two types of captive audits. There are internal audits, which generally deal with a financial committee or the captive manager will audit cash inflows or claims outflows to make sure that those are accurately reflected on the financial statements. And then there's the external audit. The external audit is when the captive engages with an independent auditor, and usually that's a CPA firm, and their duty is to produce a financial work paper that the users or the readers can look at and have a reasonable level of assurance that the financials that are reported on the audit are actually what is had or the captive has to report on its financial statements. Okay? One of the duties of the auditor is to form an opinion. The gold standard is non-qualified opinion. The okay, still good, is a qualified opinion. And an adverse and disclaimer is really code for run for the hills. You don't want any part of this captive or even business if you're looking to invest in it. The opinions are reported on the cover page of the financial audit. So it's literally the first thing that the user is reading when they look at a financial audit. Okay? So why? Fundamentally, to protect the investors. Remember, if you're looking to join a group captive, you're going to invest in that group captive. So you need to look at the audit before you invest in a group captive. And then, of course, the second thing is you got to satisfy the regulators. If you don't satisfy the regulators' requirements, you won't have a captive license to do business with. So what does the audit look at? Well, the audit is a look back. It's looking at the financials from most likely the calendar year of the prior year all the way through the end of the calendar year of the prior year. So it's a 12-month period. So they're looking back at the financial process, which is usually two things: the internal controls, workflows, and this really focuses on the handling of cash, premiums in, deposits to the bank, access to checking accounts, and signing checks. Those are internal controls. The auditor will most definitely ask for a policy and procedure for internal controls regarding cash. You don't want one person controlling the life cycle of cash, not only within a captive, but within any business. And then, are the financials reported in GAAP, which is generally accepted accounting principles? Okay, so the auditor is going to look at your financials and say, does it follow GAAP according to the principles? Financial statement support. This really has to deal with cash. The captive is reporting, say, $1 million of cash, but if there are not $1 million of cash or cash equivalents in a bank, where is it at? So that's called support. You need to match what's being reported on the financials with some sort of support in a bank statement or policy and procedure, invoice, something to that effect. Okay? Solvency. Arthur Andersen used to be part of the Big Five accounting firms. They were the auditor for Enron. Back in 2001, Arthur Andersen gave Enron a non-qualified opinion, and then subsequently, months later, they went insolvent. In that situation, Arthur Andersen fooled many investors to thinking that Enron was a qualified, investable business, when in fact it wasn't. As a result, we now have the Big Four accounting firms. Arthur Andersen was the fifth. Arthur Andersen is no more. So if a auditor signs off on a business with a non-qualified opinion and that captive goes insolvent, boy, the auditor has a lot to explain for, because they have to comply with generally accepted audit standards, GAS. Now, if the auditor says, no, wait a minute, I was given information from the captive manager and it was effectively garbage, remember, the auditor is not ensuring right or wrong. They are opinionating on fair and accurately. Okay? So if the captive manager submits garbage in, what do you expect to have garbage out? So the auditor has a solvency risk as a first layer, then the captive manager. So, hope this was interesting. Next week, we're going to talk about questions every user should ask when they get their hands on a financial audit. Until then, have a good week. Bye now.